With Wealth for Life, there is a little bit of personal care.
We didn't go through the investing, and I don't think we'd be where we are today.
I would never go to a bank directly again.
Let's do it together.
They're giving me more confidence.
We feel totally secure now.
It was just easy.
There's a capability there that we didn't even know we had.
Stressful wise, Anthony's always there.
After the first meeting, those fears were gone.
They make us comfortable before we made the next step to invest.
Who wants to work until they're 80? Seriously.
We actually have seen the benefits.
It's like nothing's changed, but we're getting wealthier every day.
They've laid out the plan out for the next 20 years and
looks great.
And I know exactly where I'm going.
They really are the real deal.
We feel included.
I'm able to retire at a very young age.
We're in the process of building our dream home after 18 years being stuck in the one home.
Financial independence for us and for our children.
Build something for our son, Rocco.
And set up our kids' futures as well.
Set themselves up for life.
They were amazing.
So certainly will make a big difference to you.
They changed our lives.
We feel included.
Go to Wealth for Life. Full stop.
Hi guys, Anthony Peluso here, CEO and founder of Wealth for Life. So, the question, should I buy established property or should I buy off the plan? Question we get asked quite a lot, and I know there's a lot of talk online that one is better than the other. You know, there's all these for and against for established property, off the plan, purchases and so on. Well, again, I'm only going to talk to you about my experience, okay? My personal experience and the experience that we have through our database and through our clients. The reality is that it doesn't matter. There are no absolutes, okay? It comes down to your existing situation, to your personal circumstances and situation, okay? I have more than enough evidence and proof that both are just as good, okay? I personally have a lot of established property in my portfolio. There are pros and there are cons for buying established property, okay? And I'm going to cover them in a minute. There are also a lot of pros and cons for buying off the plan, okay? But it's the wrong viewpoint to have, because based on your existing situation, your current situation, your financial capacity, your end goal, it may dictate which one you invest in, okay? So, you know, when you look at it, established real estate, okay? It exists, it's there. You can touch it, you can feel it, okay? So what are some of the pros? Well, the fact of the matter is that it's established, okay? You settle on the finance, you can get a loan immediately, okay? Get a loan immediately, and get tenants in there straight away. No waiting for any construction, no delays, instant rent. So there's a lot of advantages to that because you know exactly what you're getting right there and then, okay? What are some of the disadvantages, right? Well, you pay full stamp duty, okay? Which is really an unnecessary cost that goes straight to the government that you get to claim as part of your cost base if and when you should sell, or when you sell your property later on. So you've also got then the potential maintenance issues that actually come with that. Now, depending on when the dwelling was built, you know, there may be some warranty that you fall out of, or some construction that's no longer covered, part of the building that's no longer covered. But you have to take into account some servicing and some maintenance costs on an annual basis, okay? And then you've got the depreciation of the dwelling itself. Now, again, there are different laws with regards to depreciation depending on when it was built and so on. But you tend to get less of a depreciation on an established property, certainly the older it is. Okay, and again, that shouldn't put you off, but it may dictate what you do based on your personal circumstances. And it's a fallacy to think that one performs better than the other, because that's like saying, you know, do I have my left arm or my right arm? Okay, which one's better? Well, you need both, right? It depends on your situation, where you are in life and what you can afford at the time. You know, if you've just started a brand new job, as an example, right? Let me give you an example. You've started a brand new job. banks dictate that you need to be working for at least, 3, 6, usually 6 to 12 months before you can get a loan. Right. So obviously it makes no sense to get established property, right? And it makes less sense to actually sit there and do nothing. So off-the-plan purchases may make perfect sense based on your current situation, okay? Listen, a bad property is a bad property, whether it's off the plan or whether it's established, okay? So it comes down to your current situation. You may need to wait 12 months before you can actually get finance, so buying something off the plan may make perfect sense, okay? You get to enjoy the capital growth over that 12-month period, or potential capital growth, again, depending on what you've bought and where you've bought, over that 12-month period, and you've got no costs other than putting down a deposit and the interest on that deposit, obviously. You've got no costs associated with that, so you're getting this free capital growth without a large expense of a mortgage in between. Okay? Now, when you're buying off the plan, some of the advantages are that potentially, again, depending when you buy it, especially in Australia right now, you may get some exemptions with regards to stamp duty. Okay? If you're buying, if you're buying house and land packages or a house and land project, you only get to pay stamp duty on the land, okay? Because it's calculated based on what's existing at the time you signed a contract, which is just the land value, not the construction, okay? You then have the benefit as well of being able to not have any, not have any maintenance issues, because if you're buying good property, new property, with a reputable builder and the quality's done very well, you really shouldn't have the headache of any maintenance issues for at least 5 or 6 years. Okay, and that really depends again on the quality of your builder and your construction team. And really, who wants the headache of having to handle maintenance issues every 12 months? Because that's money out of your pocket. Okay. And obviously, number 3, your depreciation is much greater because the property is newer. Okay, so you get to claim the building cost over a 40-year period, and the fixtures and fittings being newer, you get to claim the full depreciation, okay? So without getting into some accounting practices, but there are a lot of advantages of actually buying off the plan, okay? What's the risk of buying off the plan? Well, so again, you're putting down a deposit and you're waiting for a point in the future, it can be 3 months, 6 months, 9 months, before you get finance or obtain finance. So what does that mean? Well, it means that you need to have a similar financial position, if not better, in 12 months' time, as you did when you had approved or when you put down a deposit 12 months earlier, or when you signed contracts. It does carry the risk that if your finances change, if you lose your job, you may not be able to get finance on a piece of real estate that you were contracted to sometime in the future. Okay, so yes, there's that risk. The other risk, obviously, is if the market goes down in value. Okay, if the market goes backwards or drops, or the real estate drops in value, you may have some valuation issues which may require you to contribute more cash or more equity to the transaction. Okay, you do run that risk. But generally speaking, I think if you're working with the right people and the right team, all of these risks for established property and off the plan property can be mitigated. Okay. And the fact that one performs better than the other, in my experience, and again, just my experience, is not true. I'm sure other people out there in the market will tell you something different. I've bought a ton of off the plan real estate, being apartments, townhouses, even houses, and I've bought a lot of established property, 1960s units, 1980s houses. I've built a lot of my portfolio as well. So each perform based on other criteria, okay? The properties are not going to do better than each other if they're off the plan or established. That's not what makes a property a good property, okay? There are other factors that will determine whether you've purchased good property or not, okay? If you buy an established property in an undesirable location where there's no employment, there's no population, limited infrastructure, no planned infrastructure, who really cares that it's an established property and it's on a big parcel of land? And I've got countless examples of people that have bought established property, have had no growth, right? Hard to rent out for 6 or 7 years. right? Then I've got personal examples where I've bought on, in boutique suburbs off the plan. I mean, my first purchase was an off the plan apartment in Fitzroy Street, St Kilda. Okay, on a main street, obviously, right? 1.5 bedrooms. Okay, a tanning salon out the front, a church out the front, a busy road, and I tripled my money in 10 years. So, and it was a ground floor apartment on, in a big building. It's done very, very well for me, continues to do very well for me. So it makes no sense to me when I hear some of these arguments out there in the market that off the plan is better than established or vice versa. Okay, there is other criteria, more important criteria that you need to take into account to determine whether you're buying a quality asset or not. Okay, and a lot will be determined based on your existing situation. Okay, it could be for tax reasons. It could be that you want to get a claim this financial year. There are many factors to take into account. The most important thing, it always comes back to this. What is it that you are looking to achieve? Why are you doing this? What does the end result look like? What are you looking to achieve from investing in real estate? That's the better question to ask. Because at the end of the day, you don't really care what type of real estate you buy. Okay, I'll say that again. You don't really care what type of real estate you buy, because the only real estate you actually want to buy is your own home. Okay, think about that for a minute, okay? You're only investing in real estate because real estate is a tool to attract finance, okay? We borrow money from the bank, we invest in real estate, our real estate grows in value, we get good cash flow from rent, and we get to a point sometime in the future where we've created wealth from using real estate as an asset class, okay? So it's an investment exercise. It's a money-making activity, okay? So just disconnect from the fact that it's real estate. It's attractive because the banks lend us so much money against the value of that asset because they see it as very little risk. They'll lend you up to 95% of the value of that asset in most cases, especially if it's your own home. And from an investment perspective, you can get anywhere from 80 to 90% against the value of that asset because banks see it as a little, as low risk. That's why they lend you so much, okay? So focus more on the money, focus more on the numbers, focus more on the exit strategy and why you're doing this. Because I've got countless examples, again, of established property, off-the-plan purchases, apartments, units, townhouses, houses. People tell me that apartments don't work. Now, we don't actually do a lot of apartments, but people always tell me apartments don't work. And I always look at my real estate portfolio and have a look at the growth in my apartment portfolio. And it makes very little sense to me what people say, okay? They're using the wrong criteria to measure the success or the performance of that piece of real estate, okay? Obviously, there are certain pieces of real estate that you shouldn't buy, you shouldn't get into. I cover them off on previous educational programs and webinars and seminars, But one of the rules I look at is have a look at what banks are prepared to lend you against the asset class that you're purchasing. Okay, if a bank turns around and says, Anthony, we're going to lend you up to 90-95% against this piece of real estate, what's the bank telling you? They see very little risk in this asset class. Yes, you'll have to pay some lender's mortgage insurance, right? But even 80% is a good deal, right? If banks are prepared to lend you up to 80%, they don't see the market dropping by more than 20%, and they're pretty comfortable with that piece of real estate that you're about to purchase or invest in. If the bank turns around and says, hey, you know what, we're only going to lend you 60-65%, now some of it may be determined by your financial position, your criteria, your serviceability, but generally speaking, if a bank is only going to lend you 65 to 70% against a piece of real estate, it's their way of telling you that they see a lot of risk with that piece of real estate, okay? And remember, this is about numbers, this is about investing, so that's where you should probably be cautious and have a look at what you're doing, okay? But banks are very good indicators with regards to whether you're buying something that they see as valuable because they're putting in a majority of the money. It's like a business, it's like they're your business partner. Banks are your business partner. And if they're prepared to put a majority of the money in, that's their way of telling you that they see this as a pretty good investment and very low risk for them. Okay? If you want to know what you're buying, whether it's good or not. Okay? And that's one of the criteria. But don't get caught up on whether it's off the plan or established. It's just nothing more than a distraction. Okay? The main thing is to understand, will this help me achieve my financial goal? Okay? Will it help me get to where I want to get to faster, or will it take longer to get there? Okay? And that's what we focus on here. Because we have access to everything, be it established, be it off the plan, be it units, be it apartments, be it, across, multiple states. So don't fall for the trap of one is better than the other, because in my experience, that is not the case. Okay? There's other criteria, much, much more important criteria that actually determines the performance of the piece of real estate than whether it's off the plan or whether it's established. All right, so I hope that makes sense, guys. If you've got any questions with regards to today's subject, should I be buying off the plan or established property, hit us up at wealthforlife.com.au. You can find us on Facebook, YouTube, Instagram, and how many other platforms are we on, Mr. Paul? TikTok. I still have no idea how to use TikTok. And LinkedIn, of course. Don't forget LinkedIn. But I'd love your feedback. Love your questions. I'm interested in what you have to say about that, and if that's real to you or not. But in my experience, remember, this is all about wealth creation. Okay, the only home you actually ever want is your own home. Okay, there's just an attractive tool called finance that helps us create wealth, and it's leveraged against the piece of real estate. That's why we invest in real estate. All right, guys, take care. Be safe. 2021, make it your best year ever. See you soon.